There is a language spoken on Wall Street, a dialect of complexity and jargon designed to make the simple seem profound and the dangerous seem safe. It's a language of Greek letters and arcane formulas, of beta and alpha, of standard deviations and sharp ratios. It is a language meticulously crafted not to illuminate, but to intimidate. And at the heart of this language is a single foundational word that has been twisted and contorted to serve the house, not the player. That word is risk. For generations, we have been taught to accept their definition without question. We have been told that risk is volatility. Risk is the bumpiness of the ride. A stock that swings wildly in price is high risk. A stock that drifts along a placid, predictable line is low risk. This definition, born in the sterile halls of academia and weaponized in the trading pits of New York, is perhaps the single most destructive piece of financial misinformation ever foisted upon the public. It is a lie, a convenient, profitable, and catastrophic lie. It is a lie that causes people to sell the world's greatest companies at the moment of maximum opportunity and to buy the world's most fragile businesses at the moment of maximum danger. It is a lie that turns investors into speculators and transforms long-term financial goals into a frantic game of beat the clock. But far away from the noise of the ticker tape and the frantic shouting of the trading floor, in a quiet office in Omaha, Nebraska, a different language is spoken. It is a language of business, of common sense, of enduring value. And in this language, the word risk has a completely different meaning. A simpler, more powerful, and infinitely more useful meaning. For Warren Buffett, risk is not the temporary fluctuation of a stock price. Risk is not a Greek letter. Risk is one thing and one thing only: the permanent loss of capital. This isn't just a semantic difference. It is a fundamental schism in investment philosophy, a fork in the road that leads one investor to a lifetime of anxiety and mediocre returns, and the other to a state of calm, rational wealth creation. To confuse the temporary for the permanent is the cardinal sin of investing. To mistake volatility for risk is to mistake the shadow for the monster. Today, we are going to learn the language of Omaha. We are going to dismantle the great deception of Wall Street piece by piece, and in its place, we will construct a new, stronger, and more resilient understanding of what truly constitutes financial danger. This is not just another piece of financial education. This is a paradigm shift. This is the key to unlocking Buffett's first and most important rule: never lose money. And his second rule: never forget rule number 1. By the end of this journey, you will no longer see a plunging stock market as a source of fear, but as a source of opportunity. You will learn to immunize your portfolio from the real threats that can destroy wealth, and you will finally understand the profound difference between the price of a stock and the value of a business. This is the final promise: to redefine risk, to protect your capital, and to transform your investor mindset forever. Let us begin by dissecting the beast itself. Where did this flawed idea of risk come from? It wasn't born in the trenches of business or forged in the crucible of real-world capital allocation. It was conceived in the abstract world of academic finance, specifically within what is known as modern portfolio theory, or MPT. Developed by economist Harry Markowitz in the 1950s, MPT was a noble attempt to apply mathematical rigor to the messy world of investing. Its central premise is that investors can construct a portfolio to maximize returns for a given level of risk. But to make the math work, it needed a quantifiable, measurable proxy for risk. The number they chose was beta. Beta measures a stock's price volatility relative to the overall market. A beta of 1 means the stock moves in line with the market. A beta greater than 1 means it's more volatile. A beta less than 1 means it's less volatile. And just like that, with the stroke of a chalk pen on a university blackboard, risk was officially defined as price fluctuation. The financial industry seized upon this idea with ferocious enthusiasm, not because it was true, but because it was useful. It was useful because it could be calculated, plotted, and plugged into sophisticated-looking models. It gave the entire profession a veneer of scientific precision. Financial advisors could now present clients with colorful charts showing, quote, risk-adjusted returns, assuring them that their portfolio was optimized. Mutual funds could market themselves as low beta or low volatility, promising a smoother ride. The entire ecosystem of financial products and advice became built upon this single, shaky foundation. The problem is that the real world doesn't care about the elegance of a mathematical formula. The map, as they say, is not the territory. To illustrate the catastrophic failure of this academic definition, we need only travel back to the early 1970s, to a period dominated by a group of stocks known as the Nifty 50. This was a collection of about 50 large-cap American companies, seen as the pinnacle of corporate excellence. Names like Coca-Cola, IBM, Polaroid, and Xerox. They were considered one-decision stocks. You bought them, and you never had to sell. They had everything an investor could want: dominant market positions, consistent earnings growth, and brand names that were household words. According to the gospel of modern portfolio theory, these stocks were the definition of low risk. Their earnings were stable, their dividends were reliable, and their prices for a long time only went up. They had low betas. They were the safe, prudent choice for any serious long-term investor, from the largest pension funds to the smallest retail accounts. Wall Street fell deeply in love. Analysts wrote glowing reports, justifying ever higher valuations. The narrative was intoxicating. These companies were so good, so dominant, that no price was too high to pay for them. By 1972, the mania was in full swing. Coca-Cola was trading at 48 times its earnings. Avon was at 65 times earnings. Polaroid, the Apple of its day, commanded a staggering valuation of 91 times earnings. The market was essentially saying that it would take nearly a century of the company's current profits to justify its stock price. But nobody cared. The volatility was low. The beta was stable. According to the official definition, the risk was minimal. Then, reality intervened. The bear market of 1973-74 arrived like a brutal winter storm. The economy soured, inflation spiked, and the entire market was crushed. But the Nifty 50, the safe stocks, were the epicenter of the devastation. Polaroid stock fell an astonishing 91%. Avon collapsed by 86%. Xerox was down 71%. Even the mighty Coca-Cola lost nearly half its value. Investors who had bought into these low-risk companies at the peak of the mania suffered a bloodbath. It wasn't just a temporary dip. For many, it was a permanent loss of capital. Someone who bought Polaroid at the top in 1972 would have had to wait decades just to get back to even, a period so long that inflation would have destroyed the purchasing power of their original investment anyway. What went wrong? Modern portfolio theory, with its obsession with beta and past price stability, was completely blind to the most important risk of all: valuation risk. The risk of paying too much. The prices had become completely detached from the underlying business reality. The businesses themselves were, for the most part, still good. Coca-Cola was still selling soda. But the price paid for a piece of that business was astronomical. The Nifty 50 disaster is the foundational anecdote that shatters the Wall Street definition of risk. It proves with brutal clarity that a low volatility stock can be an extraordinarily high risk investment if the price is wrong. Conversely, as we will see, a highly volatile stock can be a wonderfully low risk investment if the price is right. The market had mistaken stability for safety, and in doing so, had walked willingly into a financial buzzsaw. The failure of the Nifty 50 narrative stems from deep-seated psychological principles that Wall Street's definition of risk actively exploits. The primary cognitive bias at play is the herd mentality, or what is sometimes called social proof. When everyone around us is doing the same thing, we assume it must be the right thing to do. In the early 1970s, every major bank, every respected portfolio manager, and every financial publication was championing the Nifty 50. To doubt their wisdom was to appear foolish, to stand against the entire current of expert opinion. This creates a powerful feedback loop. As more people buy, the prices go up, which validates the initial decision and pulls even more people in. The rising price itself becomes the justification for buying. This is the very definition of a bubble, and it is fueled by our deep, primal need to belong and to conform. Alongside this is the powerful authority bias. We are conditioned to trust experts, especially when they come armed with complex formulas and impressive credentials. The economists who created modern portfolio theory were Nobel laureates. The financial advisors promoting these low-beta strategies were from the most prestigious firms on Wall Street. They presented beta as a scientific, objective measure of risk. For the average person, questioning this was like questioning a doctor's diagnosis. It felt arrogant and foolish. We outsourced our critical thinking to the experts, who, in this case, were all looking at the same flawed map. A third bias, the illusion of control, cemented the deception. Complex mathematical models give us a sense that we can tame the wild, unpredictable nature of the market. The idea that you can quantify risk down to a single number like beta is incredibly seductive. It suggests that the future is knowable and that danger can be precisely managed. It turns the art of investing, which is about making judgments in the face of uncertainty, into a science of plugging variables into a formula. The financial industry loves this because it allows them to sell products that promise this control, this optimization. The tragedy is that this illusion of control makes investors blind to the real, unquantifiable risks, like a sudden change in consumer tastes, a new disruptive technology, or, as in the case of the Nifty 50, the simple, brutal risk of paying a ludicrous price for a good asset. These three biases, herd mentality, authority bias, and the illusion of control, create a perfect storm. They lead to a market where assets are priced not on their fundamental value, but on the collective psychology of the crowd, a psychology that is being guided by a fundamentally broken definition of risk. So how do we break free from this mental prison? How do we adopt an applied mental model that immunizes us against this great deception? The first step is to conduct a personal risk audit. This is a blueprint for rewiring your brain. It consists of asking yourself a series of brutally honest questions. First, in my own words, without using any jargon, what am I most afraid of when I invest my money? Is it that the number on the screen will go down for a few months? Or is it that in 10 or 20 years, the purchasing power of my capital will be permanently less than it is today? This single question forces you to differentiate between volatility and permanent loss. If you can honestly say you fear the latter far more than the former, you have taken the first step toward the Buffett mindset. Second, when I evaluate a potential investment, what is the very first thing I look at? Is it the stock chart, showing its past price movements? Is it the beta number on a financial website? Or is it the company's financial statements and a deep consideration of its business model? The path of the 99% is to look at the price chart first. This anchors them to the very volatility that Wall Street wants them to focus on. The path to true risk management is to ignore the chart, at least initially, and act like a business analyst, not a stock market pundit. Third, who benefits from my current definition of risk? If your definition of risk is volatility, the people who benefit are your broker, who earns commissions when you trade in and out of stocks based on their price swings, and the financial media, which thrives on the drama of market fluctuations. If your definition is the permanent loss of capital, the only person who benefits is you. This question exposes the incentives behind the prevailing narrative. Fourth and finally, can I explain the primary risks of each of my investments as if I were explaining them to a 10-year-old? Not the market risk or the interest rate risk, but the business risk. For example, the risk to this soda company is that people might stop drinking sugary drinks. The risk to this social media company is that a new, more popular app could appear and steal its users. If you cannot articulate the fundamental, business-level risks simply, it means you are likely relying on abstract, academic concepts of risk, which, as we've seen, are useless in the real world. Performing this audit isn't a one-time event. It's a continuous mental discipline. It's about consciously rejecting the language of Wall Street and replacing it with the language of business ownership. It's the essential first step in building a portfolio based on reality, not on elegant but empty formulas. The consequences of failing to make this mental shift are all around us. The path of the 99% is littered with the financial wreckage caused by mistaking volatility for risk. Consider the typical retail investor. We'll call him John. John is a diligent saver and wants to do the right thing for his family's future. He's been told to avoid risky stocks, so he consults his online brokerage account, which conveniently lists the beta for every stock. He diligently screens for companies with low betas, believing he is engaging in sophisticated risk management. He ends up with a portfolio of stable, predictable, but slow-growing utility companies and consumer staples. He feels safe. He has avoided volatility. But what has he really done? He has likely constructed a portfolio of businesses whose prices already reflect their stability. They are often overpriced precisely because they are perceived as safe. His capital may not fluctuate much day to day, but its long-term growth potential is severely capped. He's chosen a smooth ride to a mediocre destination. Even worse is the story of Jane, the news-driven investor. Jane also believes risk is volatility. When the market plunges, as it did in March of 2020, she sees the wild price swings and the screaming headlines on financial news channels. Her portfolio is down 30%. The risk is flashing red. Her fight-or-flight instinct kicks in, fueled by the Wall Street definition. She sells everything, converting a temporary, on-paper dip into a catastrophic, permanent loss of capital. She tells herself she is de-risking her portfolio. A few months later, the market has not only recovered but has roared to new highs. Jane, sitting in cash, is paralyzed. She missed the entire rebound. The low-risk move, driven by a fear of volatility, has permanently impaired her financial future. This is the antithesis of the Buffett approach. The 99% are programmed to buy when volatility is low, prices are high and stable, and sell when volatility is high, prices are low and chaotic. They systematically buy high and sell low, all under the guise of risk management. They trade frantically, generating endless commissions for their brokers, while their own net worth is eroded by 1,000 poor decisions, all stemming from that single, flawed definition. They mistake the fever for the disease, and in their attempt to cure the temporary fever of volatility, they kill the patient, their long-term returns. The direct financial connection here is stark and quantifiable. Let's look at the balance sheet of an investor's life, their net worth. When you define risk as volatility, your primary goal becomes smoothing the short-term path of your portfolio's value. You will pay a real, tangible price for this perceived smoothness. You might buy complex financial products like structured notes or buffered ETFs that promise downside protection. These products come with high fees that act as a constant drag on your returns, a guaranteed small loss to protect against a temporary larger one. Over a 30-year investing horizon, these seemingly small fees can consume a staggering portion of your potential wealth, a permanent loss of capital paid as a premium for a false sense of security. Let's quantify the nifty 50 example. Imagine an investor put $100,000 into Polaroid in 1972 when it was trading at 91 times earnings. This was a low-beta safe stock. By 1974, that $100,000 was worth less than $9,000. That is not volatility. That is the virtual annihilation of capital. It would require a more than 1,000% gain just to break even. The financial statement of that investor's life now has a permanent hole blown in it. Now contrast this with the Buffett definition. If risk is the permanent loss of capital, your entire strategy changes. You are no longer trying to minimize the wiggles in your account statement. You are trying to maximize the long-term intrinsic value of the businesses you own. This means your focus shifts from the stock price to the company's financial health, its balance sheet, its income statement, and its cash flow statement. You understand that a temporary 50% drop in the stock price of a great company does nothing to alter its long-term earnings power. On your personal financial statement, this is an unrealized loss. It is temporary, It is noise. But if you own a business that is fundamentally deteriorating, its debt is piling up, its profits are turning to losses, that creates a real impairment to the value of your asset. That is the true risk, the risk that the future stream of cash you are entitled to as an owner will dry up. By focusing on this, you avoid the Polaroid-like situations. You might endure more short-term price volatility by owning great growth companies, but you dramatically reduce the probability of a true catastrophic permanent loss. The financial result is a portfolio that may be bumpier in the short term, but its value compounds at a much higher rate over the long term, leading to a profoundly different and vastly superior financial destination. Shifting your definition of risk is the single most important change you can make to the liability side of your mental balance sheet. Having dismantled the flawed architecture of Wall Street's definition, we must now build its replacement. We must erect a new intellectual framework, forged in the common-sense realism of business ownership. This is the Buffett doctrine, and its cornerstone is the redefinition of risk as the permanent loss of capital. It sounds simple, but within that simplicity lies a universe of profound implications. Permanent is the operative word. It acknowledges that prices will fluctuate, that markets will panic, that recessions will come and go. These things are temporary. A permanent loss, however, is a hole from which you cannot easily dig out. It is the kind of mistake that sets your journey to financial freedom back by years, or even decades. According to Buffett and his intellectual mentor Benjamin Graham, there are really only three fundamental ways an investor can suffer a true, permanent loss of capital. Understanding these three gates of risk is the foundation of genuine portfolio protection. The first and most common is valuation risk. This is the risk we saw with the Nifty 50. It is the simple, brutal risk of overpaying for an asset, no matter how wonderful that asset may be. Every business, no matter how great, has an intrinsic value, a calculated private owner estimate of what it's worth. If you pay a price far above that intrinsic value, you are making a high-risk bet. You are counting on future growth to be so spectacular that it justifies your optimistic purchase price. If that growth fails to materialize or even just slows down, the price can collapse back toward the real value, and you are left holding the bag. A wonderful company can be a terrible investment if bought at the wrong price. The second gate of permanent loss is business risk. This is the risk that the underlying business you've invested in will fundamentally and permanently deteriorate. Its competitive advantage may erode. A new technology might make its product obsolete. A series of terrible decisions by management could saddle it with debt and destroy its profitability. This is the risk that the intrinsic value of the business itself will decline over time. No matter how cheap your purchase price, if the business is melting like an ice cube, you will likely suffer a permanent loss. This requires you to think like a business owner, not a stock trader. You must ask, is this company stronger and more profitable today than it was 5 years ago? And is it likely to be even stronger and more profitable 5 years from now? The third gate is leverage risk. This refers to the danger of excessive debt, both for the company you invest in and for you as an investor. For a company, a mountain of debt acts as a guillotine hanging over its head. In good times, leverage can amplify returns. But during a recession or a period of tight credit, that debt can become an anchor that pulls the entire enterprise underwater. A temporary business downturn can become a permanent bankruptcy if the company can't make its interest payments. For the investor, using leverage or margin to buy stocks is even more dangerous. It introduces the risk of a margin call, where a temporary drop in stock prices can force you to sell at the absolute worst possible time, turning a recoverable dip into a devastating permanent loss. Buffett's famous quote, "You only find out who's swimming naked when the tide goes out," is a direct warning about the dangers of leverage. To truly practice capital preservation, an investor must screen every potential investment through these three gates. Am I paying a sensible price? Is the underlying business strong and durable? Is the company, and my own financial position, protected from the dangers of excessive debt? Answering these three questions honestly is the essence of true risk management. It has nothing to do with beta and everything to do with business reality. A perfect, if painful, story from Buffett's own career illustrates the brutal reality of business risk, the second gate of permanent loss. It's a story he tells willingly, as a lesson in humility and a reminder that even the greatest investors are not immune to mistakes. This is the story of Dexter Shoe Company. In 1993, Berkshire Hathaway acquired Dexter Shoe, a manufacturer of high-quality, American-made footwear based in Maine. Buffett was deeply impressed by the business. It had a long history, a strong brand in its niche, and a track record of profitability. He paid $433 million for the company. But this was not a cash transaction. In a move that he would come to regret for the rest of his life, he paid for the acquisition entirely with shares of Berkshire Hathaway stock, 25,203 shares to be exact. At the time, Buffett believed Dexter had what he called a durable competitive advantage. He thought that its brand and reputation for quality would protect it from foreign competition. He was wrong. Almost immediately after the acquisition, the competitive landscape began to shift dramatically. Low-cost shoe manufacturers from overseas flooded the market with products that were nearly as good, but vastly cheaper. Dexter's supposed moat proved to be a shallow ditch. Its profitability evaporated. For years, Berkshire poured money into Dexter trying to turn it around, but it was a futile effort. The business was fundamentally broken. The competitive advantage was gone, forever. Eventually, they had to shut it down. The entire $433 million investment went to zero. This was a 100% permanent loss of capital. But the story gets far, far worse. Remember, Buffett didn't pay with cash. He paid with Berkshire stock. Those 25,203 shares of Berkshire Hathaway that he traded for a dying shoe company would, as of today, be worth well over $10 billion. This single mistake, born from a misjudgment of Dexter's business risk, cost Berkshire shareholders billions in lost opportunity. Buffett himself calls it his worst deal ever, far worse than any other investment mistake he has made. He wrote in his 2007 letter to shareholders, "I gave away 1.6% of a wonderful business, one that would become far more wonderful, to buy a worthless business." The Dexter Shoe story is the ultimate cautionary tale. It shows that permanent capital loss isn't an abstract concept. It's a real and painful possibility. It demonstrates that the most important factor is not a company's past performance but its future durability. Buffett misjudged the strength of Dexter's moat, and he paid a terrible price. He failed to properly assess the business risk, and the result was a total and permanent loss of the capital he invested. This is the kind of risk that beta will never, ever capture. The psychological principle that underpins Buffett's focus on permanent loss is one of the most powerful forces in human behavior: loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky showed that for most people, the pain of losing a dollar is psychologically about twice as powerful as the pleasure of gaining a dollar. We are hardwired to feel losses much more acutely than gains. This is why the Wall Street focus on volatility is so emotionally potent. The sharp, sudden drop in a portfolio's value triggers this intense loss aversion, creating a powerful impulse to make the pain stop by selling. Buffett's framework is a genius act of psychological jujitsu. By redefining the loss that matters, he sidesteps this emotional trap. He mentally reframes a 30% market downturn not as a loss, but as noise or opportunity. The only loss he allows himself to feel with that intense, gut-punching pain of loss aversion is a permanent one. He channels that powerful emotional force away from reacting to market quotes and toward the diligent, upfront work of avoiding bad businesses and overpaying. This is a crucial mental shift. The average investor's loss aversion is tied to the ticker tape. Buffett's loss aversion is tied to his analytical checklist. Another key bias that this doctrine helps to override is the endowment effect. This is our tendency to overvalue something simply because we own it. Once an investor buys a stock, they become psychologically committed to it. If the business starts to deteriorate, if the story of Dexter Shoe starts to play out in their own portfolio, the endowment effect makes it incredibly difficult to admit the mistake and sell. They'll say, "I'll just wait for it to come back to what I paid for it." This is a recipe for turning a small loss into a permanent catastrophic one. Buffett's relentless focus on the business reality and his brutal honesty about his own mistakes, like Dexter, is his antidote to the endowment effect. His definition of risk forces the question, knowing what I know now, would I buy this business today? If the answer is no, the rational move is to sell, regardless of the original purchase price. This discipline, this ability to override the natural emotional attachment to one's own holdings, is critical for capital preservation. To put this doctrine into practice, we can create an applied mental model called the 3 Gates of Permanent Loss checklist. This is a blueprint that any investor can use to analyze a potential investment before pulling the trigger. It's a systematic way to enforce the discipline that Buffett applies. Gate 1. Valuation Risk Assessment. The first step is to establish a range of intrinsic value for the business. This doesn't have to be a complex discounted cash flow model down to the penny. A simpler approach is often more effective. You can look at the company's owner earnings, net income plus depreciation, minus capital expenditures, and ask what a reasonable private buyer would pay for that stream of cash. You could look at the price-to-earnings ratio and compare it to the company's own history and its growth rate. The goal is not to find a precise number, but to determine if the current stock price is screamingly cheap, fairly valued, or dangerously expensive. The checklist questions are: is the current price significantly below a conservative estimate of the business's worth? Am I relying on heroic assumptions about future growth to justify this price? If I bought the entire company at this price, would I get a satisfactory return on my investment from its current earnings alone? You must be able to answer yes to the first question and no to the second to pass through the first gate. Gate 2. Business Risk Assessment. Here, you put on your business analyst hat. You need to investigate the company's competitive advantage, or moat. The questions are: what prevents competitors from eating this company's lunch? Is it a powerful brand like Coca-Cola? High switching costs like a bank? A network effect like a social media platform? A low-cost advantage like a major retailer? How has this moat trended over the last decade? Is it widening or narrowing? Read the last 5 years of shareholder letters. Does management talk rationally about the business challenges and how they are allocating capital? Or do they use jargon and promotional language? You are looking for a business that is durable, understandable, and run by honest and capable people. If you can't identify a strong and stable moat, you do not proceed. Gate 3. Leverage Risk Assessment. This is the final check for hidden explosives. First, look at the company's balance sheet. How much debt does it have relative to its equity? Could it pay off all its debt with a few years of its earnings? A company with little to no debt cannot go bankrupt. It can survive even the worst recessions. The questions are: does the company have a fortress-like balance sheet? Is its debt manageable even in a tough economic scenario? Second, look at your own finances. Are you using borrowed money to make this investment? The answer to that question must be a resounding no. Margin is a foot on the accelerator when you're heading toward a cliff. By systematically walking every potential investment through these 3 gates, you move from being a speculator reacting to prices to an investor analyzing risk. You are not asking, will the stock price go up? You are asking, what is the probability that I will suffer a permanent loss of capital with this investment? This shift in perspective is the very heart of the Buffett doctrine. The path of the 99% is a direct rejection of this disciplined 3-gate approach. It is a path of shortcuts, stories, and speculation. Instead of assessing valuation risk, the average investor chases narratives. They buy story stocks, companies in exciting new industries like artificial intelligence, electric vehicles, or cannabis, with little to no regard for their current earnings or valuation. The story is so compelling that they convince themselves that valuation doesn't matter. They are buying a lottery ticket, not a piece of a business. This is how people end up paying 100 times sales for a company that has never made a profit, virtually guaranteeing a permanent loss of capital when the hype fades and reality sets in. Instead of assessing business risk, the 99% chase fads. They pile into the hottest sector of the market, whether it's dot-com stocks in 1999 or clean energy stocks in 2021. They don't take the time to understand the competitive dynamics of the industry or the specific moat of the company they are buying. They just know that their neighbor made a lot of money in it, and they want in on the action. This is pure herd behavior, and it almost always ends with the latecomers holding worthless stock certificates in industries where supply has massively outstripped demand. The antithesis of assessing leverage risk is perhaps the most dangerous behavior of all, the gambler's mindset. This is the investor who opens a margin account and borrows heavily to magnify their bets. They see a stock moving and they want to maximize their exposure. A small move in their favor can lead to huge gains, which reinforces the behavior. But they are blind to the fact that a small move against them can lead to a total wipeout. In a volatile market, a 20% drop in a stock can trigger a margin call, forcing a sale that liquidates their entire position. They have taken a temporary market fluctuation and, through the use of leverage, have allowed it to inflict a permanent, fatal wound to their portfolio. This is the path of impatience and greed, and it stands in stark opposition to the patient, methodical, and businesslike approach of focusing on the three gates of permanent loss. The direct financial connection between these two approaches is profound and can be seen clearly on any investor's long-term statement of net worth. Adopting the Buffett doctrine of risk directly translates into superior capital preservation. Imagine two investors, each starting with $100,000. Investor A follows the path of the 99%. They get caught up in a speculative bubble, and their portfolio falls by 50% to $50,000. To get back to their starting point, they now need a 100% return. The mathematics of loss are brutal. Investor B, following the three gates model, avoids the bubble. Their portfolio of carefully selected, reasonably priced, durable businesses might fall 20% in the same downturn to $80,000. They only need a 25% return to get back to even. By avoiding the big mistake, by preventing the permanent impairment of their capital base, Investor B's path to wealth is exponentially easier and more certain. This is the defense-first strategy of value investing. On a corporate balance sheet, you see this principle in action through the concept of goodwill. When a company like Berkshire buys another company for more than its tangible assets, the difference is recorded as goodwill. If the acquired business later falters, as Dexter Shoe did, the company must take a quote, goodwill impairment charge, officially acknowledging on its income statement that the asset is worth less than they paid for it. This is the accounting equivalent of admitting a permanent loss of capital. A company that consistently has to write down its assets is a company run by management that is bad at capital allocation and risk management. A company that rarely, if ever, has such write-downs is one that is disciplined in its acquisitions, a sign of excellent executive decision-making. By learning to think this way, you are essentially learning to read the financial story of a business and identify which management teams are practicing true capital preservation and which are just gambling with shareholder money. Ultimately, defining risk as the permanent loss of capital forces you to focus on building a portfolio with a high degree of resilience. Your goal shifts from seeking maximum short-term gain to ensuring maximum long-term survival and growth. This mindset naturally leads to a portfolio with lower turnover, lower taxes, lower fees, and a higher probability of reaching your financial goals. It is the tangible financial advantage of choosing common sense over complex nonsense. We have established that the true risk is not the temporary jiggle of a stock price, but the permanent destruction of capital. And we have established that this destruction primarily occurs when we overpay for a business, or when the business itself deteriorates. This leads us to a fascinating and paradoxical conclusion, one that is completely alien to the Wall Street mindset. The volatility paradox is this: for the disciplined, business-focused investor, market volatility is not risk. It is the single greatest source of opportunity. The very thing that the 99% fear is the primary tool the professional uses to build wealth. While the rest of the world is panicking over price declines, the student of Buffett is calmly sharpening their pencil. This is because a falling stock market is the only store in the world where the customers run out screaming when the merchandise goes on sale. Buffett's entire career has been built on exploiting the emotional, irrational swings of the market. He understands that the price of a stock and the value of the underlying business are two completely different things, and that they can often diverge dramatically, especially during times of fear or greed. When fear is rampant, prices can fall far below intrinsic value. This is when volatility is your friend. It offers you the chance to buy a wonderful business at a silly price from a seller who is mistaking a temporary market panic for a permanent business problem. This single insight, more than any other, separates the amateur from the master. The amateur sees a stock that has fallen 50% and thinks, "This is so risky, look how much it has fallen." The master sees the same 50% drop and thinks, "This is so much less risky, look how much cheaper the price is relative to the value." They are looking at the exact same data point but reaching the opposite conclusion, simply because they have a different definition of risk. To the master, the risk was highest when the stock was at its peak price. The subsequent fall in price has massively reduced the risk of permanent capital loss for a new buyer. This inversion of conventional thinking is the key. To illustrate this principle in action, we must go back to one of the most dramatic and pivotal moments in Warren Buffett's early career, the Great Salad Oil Scandal of 1963. The story centers on American Express, a company known today for credit cards and traveler's checks, but which at the time also had a significant business in warehousing. Specifically, they had a subsidiary in Bayonne, New Jersey, that would inspect and verify inventory for commercial clients, issuing warehouse receipts that the clients could then use as collateral for bank loans. One of their biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. DeAngelis was running a massive fraud. He claimed to have warehouses full of valuable salad oil, and he was using American Express warehouse receipts to secure hundreds of millions of dollars in loans. The problem was, the oil wasn't there. His tanks were mostly filled with seawater, with a small layer of salad oil floating on top to fool the inspectors. In November 1963, the fraud was discovered. Tino DeAngelis's company collapsed, defaulting on $175 million in loans, a colossal sum at the time. The banks that had made the loans, holding what they thought were ironclad receipts from American Express, turned to Amex for their money. Panic erupted on Wall Street. Was American Express on the hook for the full $175 million? Would this scandal destroy the company's reputation and its core traveler's check business? The market was terrified. No one knew the answer. In the ensuing chaos, American Express stock, which had been trading at over $60 a share, was obliterated. The price plunged by more than 50%, bottoming out around $35. Volatility was off the charts. The beta skyrocketed. According to Wall Street's definition, American Express was suddenly one of the riskiest stocks on the entire New York Stock Exchange. The herd was selling in a frenzy, but Warren Buffett, then a young, relatively unknown fund manager in Omaha, saw something different. He didn't see risk. He saw confusion. And where there is confusion, there is often opportunity. He decided to do what the panicking sellers were not doing. He decided to investigate the underlying business. He didn't look at the stock chart. He went out and did on-the-ground research. He visited restaurants and banks. He talked to merchants and travel agents. He stood in line and watched people buying American Express traveler's checks. What he discovered was that the scandal, while a major headline on Wall Street, had done almost nothing to damage the company's core business. People were still using the traveler's checks. Merchants were still accepting the cards. The competitive moat around the American Express payment system was perfectly intact. He then did a financial analysis and concluded that even in a worst-case scenario, where Amex had to pay every penny of the fraudulent loans, the company's long-term earnings power would easily absorb the blow. The market was pricing the company as if it were going to die, but the business itself was barely scratched. The temporary problem had been mistaken for a permanent one. Convinced that the market was making a huge emotional error, Buffett began buying American Express stock aggressively. He ended up investing 40% of his entire partnership's capital, a massive, concentrated bet, into this single, risky stock. Over the next few years, as the fear subsided and the company's powerful earnings became clear, the stock price soared. The investment became a home run, earning his partners millions and helping to build the foundation of his legendary reputation. The salad oil scandal is the quintessential anecdote of the volatility paradox. It shows a market in the grips of extreme fear, creating massive price volatility. It shows the 99% selling indiscriminately because they define that volatility as risk. And it shows a master investor stepping into that chaos, armed with a better definition of risk, and using the market's irrationality to purchase a wonderful asset at a fraction of its true worth. The psychological principles that drive the volatility paradox are some of the most powerful biases that affect investors. The first and most prominent is the availability heuristic. Our brains give more weight to information that is recent, dramatic, and easily recalled. A terrifying market crash, with screaming headlines and pundits predicting doom, is incredibly available to our minds. It looms larger than the slow, boring, day-to-day reality of a company selling its products and generating profits. During the salad oil scandal, the dramatic story of the fraud was far more available and emotionally potent than the mundane fact that people were still buying travelers' checks. The market overreacted to the dramatic story, ignoring the underlying, less exciting reality. Buffett's genius was his ability to deliberately ignore the highly available, sensational information and focus on the more important but less obvious data. Closely related to this is recency bias, our tendency to extrapolate recent events into the future. When the market is falling, we assume it will continue to fall. We project the recent pain and fear forward, leading to the conclusion that selling is the only rational choice. This is a survival instinct gone wrong in the context of financial markets. It's what drives the panic selling at the very bottom of a bear market. Investors who sold American Express at $35 were not thinking about its earnings power in 1968. They were thinking about the gut-wrenching pain of the drop from $60 and were terrified it was going to zero. Buffett, by contrast, is a master of what psychologist Daniel Kahneman calls System 2 thinking. He overrides the immediate, emotional, System 1-inch reaction with a slower, more deliberate and analytical process. He forces himself to look at the long-term history of the business, not just the short-term chaos of the stock price. This ability to engage his rational brain while everyone else is running on pure emotion is a core part of his investor mindset and allows him to see opportunity where others see only risk. He doesn't just manage his own biases, he actively profits from the biases of others. To harness this paradox for yourself, you need an applied mental model, a pre-written script to run in your head when the market goes into a panic. We can call this the volatility exploitation checklist. This is not a tool for normal market conditions. It is a break glass in case of emergency procedure for market crashes. Step 1. Acknowledge and isolate the emotion. The first thing to do when the market is plunging and your portfolio is bleeding is to acknowledge the fear. Don't pretend you don't feel it. Say to yourself, I am feeling fear right now because my brain is reacting to a perceived threat. This is a normal biological response. By naming the emotion, you separate yourself from it. You are the observer of the fear, not its captive. This creates the mental space needed for rational thought. Step 2. Re-underwrite your thesis. Do not look at the stock price. Open your investment journal or the file where you wrote down your original reasons for buying each company in your portfolio. Go through each one and ask a single question. Has anything about this market downturn permanently impaired the long-term earnings power of this specific business? Has Coca-Cola's brand been damaged? Has Apple lost its ecosystem lock-in? Has a key patent for a pharmaceutical company been invalidated? 99 times out of 100, the answer will be no. A general market panic or a recession does not destroy the moats of great companies. This step reconnects you with your original, rational analysis, insulating you from the current irrationality of the market. Step 3. Consult your wish list. A prepared investor should always have a list of wonderful companies that they would love to own, but whose stock prices have always been too high. This is your shopping list for a bear market. During the panic is not the time to start looking for new ideas. The work should already be done. Your list should include the names of the companies and a predetermined conservative price at which you believe they would be a bargain. For example, I would love to own Company X if it ever falls to $100 a share. Step 4. Execute with courage. If a company from your wish list hits your predetermined price, you must act. This is the hardest part. It requires buying when every instinct in your body is screaming at you to sell or hide. But because you have followed the checklist, you are not acting on emotion. You are acting on a pre-planned, rational strategy. You are executing the final step of a logical process. This checklist transforms you from a passive victim of market volatility into an active exploiter of it. It provides a structure for rational behavior in an irrational environment, allowing you to turn the market's fear into your financial gain. The antithesis of this disciplined approach is the all-too-common story of the panic seller. This is the investor who has done none of the preparatory work. They don't have a clear thesis for their investments, they don't have a wish list, and they have certainly not mentally prepared for a downturn. For them, a bear market is an unscripted horror movie. Let's revisit Jane from our earlier example. In March 2020, as the pandemic began, the market went into freefall. Jane, like millions of others, watched her life savings evaporate on screen. The news was filled with terrifying projections. The availability heuristic was in overdrive. Her recency bias told her the world was ending and the market was going to zero. With no rational checklist to fall back on, she gave in to her system, one emotional brain. She sold everything near the bottom of the market, locking in a 35% loss. She told herself she was being prudent, that she was moving to the sidelines to wait for things to clear up. But the market doesn't wait for clarity. It bottoms out when uncertainty is at its peak. As the market began its ferocious V-shaped recovery over the next few months, Jane was paralyzed by indecision. Is this a real recovery or a dead cat bounce? She wondered. By the time it was obvious that the recovery was real, the market had already surpassed its previous highs. She was now faced with the prospect of buying back the same stocks she had sold, but at prices 50% higher. The path of the 99% is a tragic cycle of fear and regret. They sell out of fear and then are kept out by regret and a new fear, the fear of buying back in at the wrong time. They successfully turn a temporary market decline into a permanent impairment of their financial journey. They treat volatility as the ultimate risk, and in their frantic attempts to avoid it, they embrace the far greater risk of not being invested in the great wealth-creating assets of our time. They flee the sale, only to come back and buy when the prices have been marked up again. It is a strategy perfectly designed for failure. The direct financial connection of the volatility paradox is where the true magic of compounding is either unleashed or destroyed. Let's use the simple but powerful arithmetic of recovery. If your portfolio falls 50%, you need a 100% gain to get back to even. The panic seller who liquidates at that minus 50% mark makes that 100% climb impossible. They have realized the loss and their capital base is permanently halved. Their future financial statements will forever reflect that destructive decision. Now consider the investor who follows the volatility exploitation checklist. Their portfolio of great businesses also falls 50% in the crash. But instead of selling, they re-underwrite their theses and find them intact. They may even have some spare cash to deploy, buying more shares of those same great businesses at half price. When the market recovers and their holdings double in price to get back to their previous highs, they have not only recouped their temporary loss, but the new shares they bought at the bottom have also doubled. Their financial statement shows not just a recovery but a significant acceleration in their net worth. The volatility didn't just fail to harm them, it actively helped them. Look at this from a business valuation perspective. When American Express stock fell from $60 to $35, its price-to-earnings PE ratio was effectively cut in half. Let's say it was trading at 20 times earnings before the scandal and at 10 times earnings at the bottom. For Buffett, the risk of overpaying, valuation risk, was dramatically lower at a PE of 10. The lower price provided him with a larger margin of safety, which is the ultimate form of risk control. By buying at the point of maximum pessimism and volatility, he was making his investment objectively 20 to less risky from a permanent loss perspective. The financial result is a portfolio that experiences what Nassim Nicholas Taleb would call anti-fragility. It doesn't just survive shocks, it can actually benefit from them. By embracing volatility as opportunity, you position your portfolio to feed on the market's periodic bouts of insanity, turning widespread fear into personal, quantifiable financial gain. This is the ultimate financial transformation, viewing a sea of red on your screen not with terror, but with disciplined, opportunistic excitement. We now understand that risk is not volatility but the permanent loss of capital, and that volatility is often a source of opportunity. This leads to the next logical question. How do we proactively build a portfolio that is inherently resilient to the true risks, specifically business risk? How do we identify the companies that can withstand the tests of time, competition, and technological change? The answer lies in two of the most critical concepts in Buffett's entire investment philosophy: the economic moat and the quality of management. This is the heart of true, long-term portfolio protection. It's not about hedging or market timing. It's about owning businesses that are fundamentally difficult to kill. An economic moat, a term popularized by Buffett, is a durable competitive advantage that protects a company from competitors, much like a real moat protects a castle from invaders. It is the structural feature of a business that allows it to earn high returns on capital for a very long period. Identifying and understanding the nature of a company's moat is perhaps the single most important task for a long-term investor. There are several primary types of moats. The first is an intangible asset, like a powerful brand. Think of Coca-Cola. For over a century, the company has spent billions of dollars building a brand that is synonymous with happiness and refreshment in the minds of people all over the globe. A new soda company could have a better-tasting product, but it cannot easily replicate the psychological connection that Coke has built. That brand allows Coca-Cola to charge a premium price and maintain its market share. That is a moat. The second type is high switching costs. This occurs when it is expensive, time-consuming, or risky for a customer to switch from one product or service to another. Think of a large company that runs all of its core processes on software from a company like Oracle or Microsoft. To switch to a new system would be a massive, multi-year undertaking fraught with risk. Therefore, the company will continue to pay for the existing software even if prices go up. That inertia is a powerful moat. A third type is the network effect. This is when a product or service becomes more valuable as more people use it. Classic examples are social media platforms like Facebook, or payment systems like Visa and MasterCard. The more people that are on Facebook, the more valuable it is to be a user. The more merchants that accept Visa, the more valuable it is for consumers to have a Visa card. And vice versa. This creates a powerful, self-reinforcing feedback loop that is incredibly difficult for a new competitor to break into. The fourth moat is a cost advantage. This can come from scale, like Walmart's ability to demand lower prices from suppliers than any smaller retailer, or from a unique process or asset, like a mining company that owns the richest and most accessible deposit of a particular mineral. This allows the company to either undercut competitors on price or enjoy higher profit margins. The second pillar of this fortress, alongside the moat, is management. A great business with a wide moat can still be a terrible investment if it is run by incompetent or dishonest managers. Buffett famously says he looks for three things in a manager: intelligence, energy, and integrity. And if they don't have the last one, the first two will kill you. A great manager is, above all, a great capital allocator. The CEO's most important job is to decide what to do with the cash the business generates. Should they reinvest it back into the core business, acquire another company, pay down debt, buy back shares, or pay a dividend. Making these decisions wisely over a long period is what separates the truly great companies from the merely good ones. A management team that consistently allocates capital to high-return projects will create enormous value for shareholders. One that squanders it on foolish acquisitions or overpriced vanity projects will destroy value, no matter how good the underlying business is. Together, a wide economic moat and a team of skilled, shareholder-oriented managers create a business that is a true fortress, capable of fending off competitors and compounding shareholder wealth for decades. This is the essence of proactive risk management, owning businesses that are built to last. A powerful and enduring example of Buffett's focus on the moat and the manager is his 1972 acquisition of See's Candies. On the surface, it seemed like a strange purchase for a man running an insurance conglomerate. See's was a simple, family-owned box chocolate company based in California. It wasn't a high-tech business. It wasn't a sprawling industrial giant. But when Buffett's partner, Charlie Munger, brought him the deal, they both saw something special. They saw a fortress. First, let's examine the moat. See's Candies had a phenomenal intangible asset: its brand. For decades, See's had cultivated a reputation for quality and nostalgia, especially on the West Coast. Giving a box of See's chocolates for Christmas or Valentine's Day was a tradition. When a customer walked into a See's shop, they trusted that they were buying a high-quality product. This powerful brand gave See's pricing power. Every year, after Christmas, the CEO, Chuck Huggins, could raise the price of the chocolates by a small amount, and the customers would barely notice or care. They weren't just buying chocolate. They were buying a feeling of tradition, quality, and affection. A new competitor could open a candy shop next door and sell chocolates for half the price, but they couldn't replicate the See's brand. That brand loyalty was a deep and wide economic moat. Second, the management. When Berkshire bought See's, the company was being run by the See family, and later by a man named Chuck Huggins, who stayed on for decades. Buffett found in Huggins the perfect manager: energetic, intelligent, and brimming with integrity. Huggins loved the business and understood its essence. He protected the brand fiercely, ensuring quality never slipped. But most importantly, he was a rational capital allocator. The candy business didn't require huge amounts of capital to grow. It was a cash-generating machine. Huggins understood that his job was to run the business efficiently, maintain the brand, and send the excess cash back to Omaha for Buffett to reinvest in other opportunities. He didn't try to get into foolish new ventures or expand recklessly. He stuck to his knitting. The purchase price was $25 million. At the time, See's was earning about $4 million pre-tax, so it seemed like a fair but not screamingly cheap price. But Buffett understood that the moat and the management would allow that earnings stream to grow consistently for decades with very little additional capital investment. Since 1972, See's Candies has generated more than $2 billion in pre-tax earnings for Berkshire Hathaway, all of which was sent to Omaha for reallocation. That initial $25 million investment became one of the most successful in history. It taught Buffett a crucial lesson. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The story of See's Candies is the foundational anecdote for the importance of focusing on business quality. It demonstrates how a simple, understandable business with a powerful brand moat and trustworthy management can become a low-risk, high-return engine of wealth creation, the very definition of a fortress investment. The psychological principles that often prevent investors from focusing on moats and managers are subtle but powerful. The first is what we can call complexity bias. Our brains have a tendency to equate the complex with the sophisticated. An investor might feel more intelligent analyzing a cutting-edge biotech company with an obscure drug pipeline than a simple candy company. The simple business seems too easy, too obvious. There's a desire to find the hidden gem, the complicated story that no one else understands. This bias causes investors to overlook the obvious, durable, and highly profitable boring businesses in favor of exciting but fragile ones. They mistake complexity for a sign of potential, when in reality, it often just masks a lack of a real, durable advantage. Another critical bias is the halo effect. This is our tendency to let one positive trait of a person or company color our judgment of everything else about them. A charismatic, visionary CEO can create a powerful halo effect. Think of Adam Neumann at WeWork or Elizabeth Holmes at Theranos. Their charisma and compelling stories were so powerful that investors overlooked glaring flaws in their business models and a complete lack of a real economic moat. They fell in love with the manager and ignored the crumbling castle. Buffett's focus on integrity and rational capital allocation, often demonstrated through a long track record, is his defense against the halo effect. He is more impressed by a CEO who writes a clear, honest letter to shareholders about business challenges than one who gives a slick presentation full of buzzwords. He looks for substance and a track record of rational decisions, not just style and charisma. Overcoming these biases requires a conscious effort to favor simplicity over complexity and demonstrated competence over compelling charisma. It requires the humility to admit that a boring candy company might be a far better long-term investment than the next disruptive tech unicorn. To systematically build a fortress portfolio, an investor can use an applied mental model called the Moat and Manager Scorecard. This is a practical blueprint for grading the quality of any business before you invest. The scorecard is divided into two sections. Section 1, the Moat Assessment. Here, you score the company on a scale of 1 to 5 across the key moat sources. First, intangible assets. How strong is the brand? Is it a local, national, or global brand? Does it command premium pricing? Second, switching costs. How difficult would it be for the company's core customers to switch to a competitor? Is it a minor inconvenience or a major operational risk? Third, network effect. Does the product or service become more valuable as more people use it? Is this effect getting stronger or weaker? Fourth, cost advantage. Does the company have a sustainable cost advantage from scale, process, or location? How durable is that advantage? You assign a score for each, and then a final moat trend score. Is the moat widening, stable, or narrowing? A company with multiple strong moat sources and a widening trend is a true fortress. Section 2, the Manager Assessment. This part is more qualitative, but equally important. First, capital allocation skill. Read the last 5 years of annual reports. Has management made smart acquisitions or foolish ones? Have their share buybacks created value or destroyed it? Do they invest in high-return projects? Look at the company's return on invested capital (ROIC) over the last decade. A consistently high ROIC is often a sign of both a good business and good management. Second, shareholder orientation and integrity. Does management communicate with shareholders in a clear, candid way? Do they admit mistakes? Is their compensation structure aligned with long-term shareholder value, or does it incentivize short-term stock price gains? Do they have significant personal wealth invested in the company's stock? You are looking for managers who think and act like long-term owners because as a shareholder that is what you are. By filling out this scorecard for every potential investment, you create a disciplined, qualitative process to supplement your quantitative valuation work. It forces you to think deeply about the long-term durability of the business, moving you far beyond simply looking at last quarter's earnings report. It's a tool for identifying the true low-risk businesses, the ones built to withstand the inevitable storms of the market. The path of the 99% is to completely ignore this deep, qualitative analysis. It is the path of the speculator, not the business owner. The antithesis of analyzing a moat is chasing a fad. The average investor gets excited about what is popular now. They don't ask about the durability of the competitive advantage. They only ask if the stock is going up. Think of the investors who piled into 3D printing stocks a few years ago. The story was exciting. A new industrial revolution. But very few stopped to ask, what is the moat here? Is the technology proprietary? Are there high switching costs? The answer was no. The technology was easily replicable, and soon dozens of companies were competing in the space. driving profit margins to zero. The stocks collapsed, and those who chased the fad without analyzing the business structure suffered massive permanent losses. The antithesis of analyzing management is falling for the visionary CEO. The 99% are often seduced by a charismatic leader who promises to change the world. They invest in the story, not the substance. They don't read the financial statements to see if the CEO is a good capital allocator. They just watch the interviews and get swept up in the hype. This leads them to invest in companies that are essentially cults of personality, which often burn through massive amounts of cash in pursuit of an unattainable vision. When the charismatic leader inevitably stumbles or departs, the entire investment thesis collapses because it was built on a person, not on a durable business. This approach is a form of intellectual laziness. It is easier to get excited about a new technology or a charismatic leader than it is to read a decade's worth of annual reports. But it is this diligent, methodical work of assessing the moat and the manager that provides true portfolio protection and separates long-term investment success from short-term speculative gambling. The direct financial connection of this fortress-building approach is crystal clear on a company's financial statements and consequently in an investor's portfolio returns. A wide economic moat translates directly into superior and more consistent financial performance. A company with a strong brand or high switching costs has pricing power. This means it can raise prices to offset inflation without losing customers. This shows up on the income statement as a stable or expanding gross profit margin. A company without a moat is a price taker. It must compete on price alone, leading to razor-thin margins and volatile earnings. A wide moat also leads to a high return on invested capital, ROIC. Because the business is protected from competition, it can generate high profits relative to the amount of capital it needs to employ. Compare two companies. Company A has a great moat and consistently generates a 20% ROIC. For every dollar it reinvests in its business, it creates 20 cents of annual profit. Company B is in a brutally competitive industry and earns a 5% ROIC. It has to reinvest 4 times as much capital as Company A to generate the same amount of profit. Over a decade, Company A will have created vastly more value for its shareholders. This is the mathematical engine of long-term compounding. When you own a portfolio of these high ROIC wide moat businesses, you have a collection of assets that are intrinsically growing in value every year regardless of what the stock market is doing. Your job as an investor becomes simple. Buy them at a reasonable price and let their internal compounding work its magic. This focus on business quality is the ultimate form of long-term risk management. It reduces the business risk, the risk of permanent deterioration, to a minimum. It creates a portfolio that is not just a collection of stock tickers, but an ownership stake in a league of championship businesses. The financial result is a smoother, more predictable, and ultimately far more powerful path to financial freedom. We have now assembled the core components of the Buffett doctrine. We have rejected Wall Street's definition of risk and adopted our own, the permanent loss of capital. We have learned to view volatility not as a threat, but as an opportunity. And we have committed to focusing on high-quality businesses with wide moats and excellent management to protect against business deterioration. But there is one final piece of the puzzle, the keystone that locks the entire structure together. It is the ultimate defense, the final and most crucial layer of risk control. This is the principle of the margin of safety. The concept, first articulated by Benjamin Graham and adopted as the central tenet of value investing by Buffett, is elegantly simple. You must purchase an asset for a price that is significantly below your conservative estimate of its intrinsic value. That discount, that gap between the price you pay and the value you get, is the margin of safety. It is the cushion that protects you from bad luck, errors in judgment, and the unpredictable vicissitudes of the economic world. It is the final guarantee against the permanent loss of capital. Think of it like building a bridge. If you calculate that a bridge needs to hold 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold 30,000 pounds. That extra capacity is its margin of safety. It protects against unforeseen stresses, flaws in your calculations, or a truck that is heavier than expected. Investing is no different. Your calculation of a company's intrinsic value is just an estimate. It is not a precise figure. You will inevitably make mistakes. The margin of safety is your protection against those mistakes. If you estimate a business is worth $100 per share and you pay $98 for it, you have almost no room for error. A small miscalculation or a minor negative surprise in the business could lead to a permanent loss. But if you insist on paying only $50 per share for that same business, you have a massive 50% margin of safety. Now, many things can go wrong, and you will still likely come out ahead. Your valuation could be off by 20%, and you still bought it at a discount. The company's earnings could fall short of expectations, and you are still protected. The margin of safety provides both downside protection and upside potential. The protection comes from the discount. The upside comes from the fact that, over time, the price of a stock tends to gravitate toward its underlying value. If you buy $1 of assets for 50 cents, you have a very good chance of eventually seeing that price double as the market recognizes its mistake. This is why Buffett says the three most important words in investing are margin of safety. It is not an invitation to buy bad businesses just because they are cheap. The principle is meant to be applied after you have already identified a wonderful business with a strong moat and good management. It is the final step in the process, the discipline of patience, waiting for the market to offer you a great business at a good price. A classic, textbook example of Buffett employing the margin of safety principle is his investment in the Washington Post Company in 1973. This was during the same brutal bear market that crushed the Nifty 50. The market was in a state of extreme pessimism, and newspaper stocks were particularly out of favor. Wall Street was worried about the rise of television news and the future of print media. The Washington Post, despite its acclaimed role in breaking the Watergate scandal, was not immune to the panic. Its stock price had been hammered, but Buffett, as was his habit, ignored the market sentiment and dug into the business fundamentals. He analyzed the company and saw a media fortress. The Washington Post had a dominant position in its market, a virtual monopoly that gave it tremendous pricing power with advertisers. It also owned other valuable media assets, including Newsweek magazine and several television stations. He then set about calculating the company's intrinsic value. He didn't use a fancy formula. He used simple, conservative business owner logic. He asked, if I were a private buyer, what would I pay for these assets? He calculated that the television stations alone were worth around $100 million. The newspaper, he figured, was worth at least $300 million. In total, a very conservative estimate of the intrinsic value of the entire company was at least $400 million. Then he looked at the stock price. The market was valuing the entire Washington Post company at just $80 million. The market was offering him the chance to buy $1 worth of prime media assets for just 20 cents. The margin of safety was enormous. He wasn't trying to predict whether newspaper advertising would go up or down next quarter. He didn't need to. The discount was so large that it provided a massive cushion against any near-term headwinds or errors in his own valuation. He knew that even if his valuation was off by a huge amount, he was still buying the business for far less than it was worth. Starting in 1973, Buffett began accumulating shares, investing over $10 million to acquire a large stake in the company. He had found a wonderful business, run by the capable and honest Graham family, and the market's fear was offering it to him at a ridiculously cheap price. That $10 million investment would, over the next few decades, grow to be worth over $1 billion. It became one of the cornerstones of Berkshire Hathaway's success. The Washington Post investment is the perfect illustration of the margin of safety in practice. It combines the analysis of a quality business with the unwavering discipline to only buy when the price offers a significant discount to value. This is the final and most powerful defense against the permanent loss of capital. The psychological principle that the margin of safety is designed to counteract is perhaps the most dangerous of all for an investor: overconfidence bias. We all have a natural tendency to overestimate our own abilities and the accuracy of our forecasts. An investor can do weeks of diligent research, build a detailed financial model, and become utterly convinced that their calculated intrinsic value for a stock is the correct one. This overconfidence leads them to pay a price very close to that estimated value, leaving no room for error. The discipline of demanding a margin of safety is a forced act of intellectual humility. It is a built-in admission that your forecast is probably wrong, that the future is unknowable, and that unforeseen negative events will happen. It is a buffer against your own hubris. Another bias at play is anchoring. Investors often get anchored to a stock's recent high price. If a stock has fallen from $200 to $100, they think it's cheap simply because it's 50% off its peak. But the peak price may have been ludicrously overvalued. The margin of safety forces you to anchor to your own conservative calculation of intrinsic value, not to a past price set by a euphoric market. It breaks the psychological pull of the stock chart and recenters your decision-making on business fundamentals. By refusing to buy without a significant discount, you are protecting yourself from your own worst enemy, your emotional, overconfident, and easily anchored brain. The applied mental model for this principle is the margin of safety calculator. It's less of a precise calculator and more of a disciplined three-step process. Step 1. Calculate a conservative intrinsic value range. The key word here is conservative. Use conservative assumptions for future growth. Use a discount rate that reflects the uncertainty of the future. It's better to be vaguely right than precisely wrong. One simple method is to look at the company's free cash flow per share and apply a conservative multiple to it, say 15x, which is equivalent to a 6.7% earnings yield. If a stable company generates $10 per share in free cash flow, a conservative valuation might be $150 per share. The goal is to arrive at a value that you are highly confident the business is worth, even in a pessimistic scenario. Step 2. Define your required margin of safety. This is a personal policy decision. Benjamin Graham suggested a 33% discount, buying at 2/3 of intrinsic value. Buffett, when he finds a truly exceptional business, might be willing to accept a smaller margin of safety. For most investors, a 30% to 50% margin of safety is a good rule of thumb. This is not a number to be taken lightly. It is your primary risk control policy. So, if your conservative value is $150 per share and your required margin of safety is 40%, your maximum buy price is $90 per share. You write this number down. Step 3. Be patient and uncompromising. This is the implementation phase. You do not buy the stock at $110. You do not buy it at $100. You wait for the market, in its wisdom or its folly, to offer you the stock at or below your target price of $90. This may take months, it may take years, it may never happen. That is fine. There are thousands of other stocks to analyze. The discipline is in letting the opportunities come to you, rather than chasing after them. This process turns investing from an emotional act of buying what's popular into a rational act of buying value with a built-in safety buffer. It is the ultimate expression of a defensive, business-like investment strategy. The antithesis to this patient, disciplined approach is the behavior driven by FOMO, the fear of missing out. This is the 99% path, and it leads directly to the destruction of the margin of safety. The FOMO investor sees a stock soaring and feels a desperate urge to get on board. They see their friends and people on social media bragging about their gains. They don't do a valuation calculation, they don't think about a margin of safety. Their only thought is, I have to get in before it goes even higher. This is what drives people to buy stocks at the peak of a bubble. They buy dot-com stocks in 1999 at 200 times sales. They buy housing stocks in 2006. They buy hot tech IPOs the day they start trading at double their initial offering price. In every case, they are not buying with a margin of safety. They are buying with a margin of danger. They are paying a price far above a conservative estimate of intrinsic value, and in doing so, they are making themselves incredibly fragile. The smallest bit of bad news or a shift in market sentiment can cause the stock to collapse, leading to swift and brutal permanent losses. The FOMO investor is essentially taking the exact opposite of Buffett's advice. Instead of buying a dollar for 50 cents, they are gleefully paying $2 for 50 cents worth of assets, all because they are terrified of being left behind by the crowd. It is a strategy that mistakes price momentum for business value and substitutes greed for analysis. It is the surest way to violate rule number 1, never lose money. The direct financial connection of the margin of safety is the most powerful in all of investing. It is the mathematical source of the heads I win, tails I don't lose much proposition that value investors seek. Let's quantify it. Suppose you buy our hypothetical $150 value company for $90 per share, a 40% margin of safety. Several scenarios can play out. Scenario 1. You were right. The market eventually recognizes the company's true value, and the stock price rises to $150. You have made a 67% return on your investment. The margin of safety provided your upside. Scenario 2. You were too optimistic. The company stumbles, and its intrinsic value turns out to be only $100 per share. The stock price rises to reflect this. You still make a small profit, turning your $90 investment into $100. The margin of safety protected you from a loss. Scenario 3. You were completely wrong. The business deteriorates significantly, and its value falls to $80 per share. You suffer a small 11% loss. The margin of safety acted as a powerful airbag, turning a potentially catastrophic error into a manageable loss. Now compare this to the FOMO investor who bought the same stock at $200. When the value is revealed to be $150, they lose 25%. If the value falls to $100, they lose 50%. If it falls to $80, they lose 60%. The lack of a margin of safety exposed them to the full brutal force of the market's reevaluation. On your personal balance sheet, consistently applying a margin of safety creates a portfolio with a fundamentally asymmetric risk profile. You are engineering a collection of investments where the potential upside is significantly larger than the potential downside on each individual position. Over time, this asymmetry compounds to produce extraordinary results with substantially lower than market risk. It is the ultimate fusion of capital preservation and wealth creation, the final and most vital principle in the art of long-term investing. You have just spent this time re-architecting your entire understanding of financial risk. You have dismantled a flawed and dangerous idea and replaced it with a robust, common-sense framework used by the most successful investor in history. You now possess the foundational principle of capital preservation that separates the legends from the crowd. You have discarded the academic illusion of beta and replaced it with the tangible, business-focused reality of permanent capital loss. You understand that volatility is not your enemy, but your ally. You know that the true defense is not in market timing, but in owning fortresses, wonderful businesses with wide moats and honest managers. And you have been given the ultimate tool for execution, the unwavering discipline of the margin of safety. This is more than just financial education. It is a complete operating system for rational decision-making in an irrational world. But understanding what risk is only the first fortress wall. The Buffett system is an interlocking architecture of mental models. Knowing how to define risk is useless without knowing how to precisely calculate value, or how to identify the psychological traps that make you ignore that calculation in a panic. The definition of risk is the shield. The calculation of value is the sword. You've built the defense, but you have not yet forged the weapon that creates offense. The video that is appearing on your screen right now is not a random suggestion. It is the second piece of that architecture. It is the blueprint for the sword. It bridges the gap between identifying risk and systematically exploiting it for profit. It's the link that connects the why you've just mastered with the hola, kamai, how, that builds lasting wealth. Most people will stop here, content with one piece of the puzzle. They will feel informed, but they won't take the next step to become truly effective. But you are not most people. The fact that you have watched this far proves you are part of the small percentage committed to a complete intellectual arsenal. Don't break your momentum. The foundation is laid, but the tower is not yet built. Complete the model. Click the video and continue your transformation from a market participant into a market master.